Welcome to this webinar regarding changes to charitable giving under the Tax Cuts and Jobs Act. My name is Sarah Mahaffa. As a result of the new tax bill, many individuals will no longer be itemizing when they file their returns going forward. For those that support charities and nonprofits, you may want to consider some of the following strategies before you do your charitable giving for this year. The first option that we're going to talk about is called a qualified charitable distribution. For those individuals that are over the age of 70 and a half and have traditional IRA accounts, your annual required minimum distribution can be a source of charitable giving. Rather than taking the required minimum distribution as a taxable distribution, you can direct up to $100,000 to one or more charities and designate that distribution as a qualified charitable distribution or a QCD. The distribution must go directly from the trustee of your IRA, so for example, Schwab, Fidelity, to the charity. You cannot come into possession of those funds yourself as the owner of the IRA account. This approach also reduces your adjusted gross income because the amount of the qualified charitable distribution is not counted as taxable income for the year. And this is important because your adjusted gross income impacts both your Medicare premiums and the taxation of your Social Security benefits. Since you did not pay taxes on your IRA income, you do not also receive a deduction for the qualified charitable distribution. Another option to consider is lumping multiple years of charitable contributions into one calendar year. The idea behind this approach is that your annual giving may not be enough to increase your eligible itemized expenses to an amount that is greater than your standard deduction. However, if you consider your giving over a 2-year period or a 3-year period, you may find that lumping those contributions into one calendar year will increase your itemized deductions to an amount that is greater than your standard deduction. Let's look at an example to see how this would play out. For a family that is married and filing jointly, their eligible standard deduction under the new tax bill is $24,000. They also have the following itemized expenses: state, local, and property taxes of $10,000, mortgage interest of $4,000, and $10,000 in annual charitable giving, or $20,000 over a 2-year period. As we can see in this table, if this family continues to give $10,000 on an annual basis, they will continue to claim the standard deduction in 2018 and 2019. Over a 2-year period, their deductions will total $48,000. However, if this family chooses to lump 2 years worth of charitable giving into one calendar year, 2018, that will increase their itemized deductions from $24,000 to $34,000. In this case, they would itemize their deductions when filing their return and have a total deduction of $34,000 for 2018. In 2019, however, they would not make a charitable contribution, which would only leave them with eligible itemized deductions of state, local, and property taxes of $10,000 and mortgage interest of $4,000 for a total of $14,000. For 2019, it would make sense for this family to claim the standard deduction rather than to itemize. Over a 2-year period, their total deductions would be $58,000 versus $48,000 if they chose to maintain giving of $10,000 on an annual basis. For a taxpayer in a 24% tax bracket, that's a savings of $2,400 over that 2-year period. For a taxpayer in the 37% tax bracket, that's a savings of $3,700 over that same 2-year period. Another option to be aware of is called the donor advised fund. Donor advised funds work really well with the strategy we just discussed regarding lumping multiple years of charitable contributions into one calendar year. For For some individuals, there would be a concern that lumping many years of charitable contributions into one calendar year may create some cash flow challenges for the organizations that they support. A donor advised fund is a great solution to that concern. Donor advised funds allow individuals to create an account into which they can make charitable contributions at any time, but it also allows the individual to decide when to distribute those funds in the future. The contribution into the donor advised fund makes a charitable deduction in the year the contribution was made. Then at any point in the future, the donor can select what charities to support and when the donation will be received. As we discussed in the prior example, a couple could contribute $20,000 into their donor advised fund in 2018. They would receive a charitable deduction in 2018, but then the distributions to charities would be spread over the next several years. Both Schwab and Fidelity maintain donor advised funds for our clients. The new tax bill also impacted charitable contribution limits. The deduction limit for cash contributions has increased from 50% to 60% of your adjusted gross income. The deduction limit for non-cash assets is 30% of adjusted gross income. And the deduction for appreciated capital assets is 20% of your adjusted gross income. I want to thank you for listening. I hope you have a chance to watch the rest of our webinar series.